Hello, and welcome to the channel. So, we talk a lot about real estate investing, house flipping, rental houses, but today we're going to be talking about something completely different, and I'd say a bit of a secret gem for the right kind of investor. We are talking about vacant land, and I know I can hear what you're thinking. Dirt? You want me to invest in dirt? But stick with me, because this is a strategic asset class with a unique kind of opportunity. It's not about negotiating with tenants or repairing leaky roofs. It's about patience, capital, and building long-term value. This beginner's guide is going to lay it out step by step exactly how it works, the pros, the cons, and the methods that actually make money. Let's get started. So why would anyone choose vacant land? The appeal is really in its simplicity. Imagine a real estate investment with, well, almost no daily management. No midnight phone calls about broken toilets, no tenants, no massive repair bills. It's just land. And because of that, the entry price is often a lot lower than a house or an apartment building, which makes it seem really accessible. But here's the reality check that most gurus won't give you. That simplicity isn't cheap, and what it is capital. You have to have a lot of money to get in. We're talking down payments of 20 to 45%. And while you're sitting on the land, it's not making you any money. Actually, it's costing you money in insurance and taxes. Your gain is only through appreciation, and that could take years. So it's simple, but it's not easy. It's a patience game and a deep pocket game. Let's make this crystal clear by comparing it directly to what most of us think of as real estate. Improved property, like a home. Maintenance first. Land is low, bare minimum upkeep and taxes. A house? High maintenance. Management, repair, tenant turnover. Down payment second. This one's a doozy. On land, it's high, that 20 to 45% we were talking about. For a house, you can get into it with as little as 3% sometimes. Now, cash flow. Land negative cash flow. It's money you pay to have it just sit there. A rental property? The goal is positive cash flow right away from rents. And finally, flexibility. That is land's secret that it does not want to share. Land is a piece of dirt with unlimited possibilities. You can potentially build anything upon it, subdivide it. The future is blank. A property already has something built upon it. You are limited by that built property. Land is all about future possibilities, whereas a property is all about current income. Okay, so assuming you're still with me, you're wondering, how do I actually get paid with this? There are 3 overall strategies, and then there's land banking. This is the long-term game. You buy a block of land and you just wait. You're betting that the land surrounding it will develop. New schools, new malls, highway expansion, and demand will drive the value higher in 5, 10, or 20 years. This requires expert forecasting ability and the resources to keep the asset for many years. Second is land flipping. This is the quick ROI game. You buy a piece of land that's below market value, maybe because an owner has to sell in a hurry. You do some low-level value adds like getting a survey done or checking the zoning, and you resell it straight away for profit. The trick here isn't to add a tremendous amount of value. It's about being a better sourcer, getting the deals that no one else knows about. And third, the granddaddy, development. That's where you take naked land and make it shovel-ready lots. You're dealing with entitlements, subdivision, and infrastructure planning. This has the most profit, but also the most expertise. You're kind of a mini developer. Now, within all these plans, you ought to be aware of a very significant distinction, the difference between raw land and shovel-ready lots. Raw land is what it sounds like. It's totally unvarnished. No roads, no water pipes, no sewage, no zoning approvals. It's a blank slate. Since it's so raw and has to be worked on so much, it has the greatest potential margin for return, but it takes the most amount of effort and risk. Conversely, you've got your shovel-ready lots. These lots already have the due diligence they require. The zoning is cleared, wetlands are staked out, engineering may be complete. You can actually begin digging. Because so much risk has been removed from the equation, the cost is so much higher. You're paying for that certainty. So it's a trade-off. Higher potential profit with highest effort, or less risk for a higher initial cost. Land is not land. It's an entire range of asset classes, and each has its own particular drivers. There's development land, which is zoned for residential or commercial development. Its worth is all location, zoning regulation, and what the city has in the works for infrastructure. Then there's agricultural land for crops or stock. This is correlated with commodity prices and the quality of the soil. Then natural resource land for wood or minerals. It is worth what you can get out of it and has a whole lot of involved permitting. And then lifestyle land for recreation. Hunting, camping, just getting out. Value here is driven by beauty, access, and recreation. The bottom line, don't try to be the jack of all trades. The economic conditions and regulations are completely different for each one of them. Your best bet is to select one niche, like recreational property or residential development land lots, and be an authority on it. So where do you even find these deals? Let's start online. Places like LoopNet are gigantic for commercial and land listings, with hundreds of thousands of properties and very good filters. Catalyst is also a good one because you can filter by status, e.g. distressed properties or auctions, which is great for finding motivated sellers. And then you have niche websites that appeal to specific niches. LandWatch, Land and Farm, Lands of America, and LandFlip are all excellent for farm, rural, and recreational land. These are where the for sale by owner listings will be that won't be on the major sites. But the real secret sauce, where the highest profit margins are hiding, is off-market deals with public records. That is your primary competitive advantage. You can pull tax-delinquent lists from the county. They are properties where the owner has not been paying taxes on it. They are generally very motivated to sell so that they do not lose the land altogether. You can look up code violation properties. If someone is being ticketed by the city for an overgrown lot or other issues, they might just want to get rid of the headache as soon as possible. And you can use GIS tools and assessor maps on the county website to visually look at parcels and establish owner information. A word of caution on these maps, and this is vital. They are not legally sufficient for boundaries. They are research only. You always need a professional survey for real lines. So, having found these willing sellers through public records, how do you contact them? One of the top ways is good old-fashioned mail, the yellow letter method. This involves sending a letter that looks like it's been written by hand. It's personal, it's authentic, and it gets opened and read a whole lot more than an obnoxious, clear postcard. Your message must be clear. 1. Emphasize convenience and speed. 2. Offer a cash as-is sale. 3. Tailor your message to their current situation, i.e., I see that you own an empty lot. And 4. Always include a specific call to action, i.e., call me at this phone number. The most important thing? Consistency. You don't mail one letter. You mail a series of letters over months. You stay at the top of people's minds. And that's what makes your response rate and your return on investment skyrocket. Now we've arrived at the most important part of this entire process, the thing that will either make or break you as a land investor: due diligence. Consider this your safety net. Priced out land has sneaky legal and environmental issues that can overnight render your investment useless. I'm serious. A wetland you weren't aware of, a lien you didn't know existed 20 years ago, no legal access. Any one of these is a deal killer. Serious, expert, intensive vetting is not optional. It's required. Now, how exactly does this due diligence function? Let us start with the legal and regulatory. First, the title and ownership. You must take a full title search and buy title insurance. This protects you against hidden claims, old liens, or mistaken past history of ownership. It's a flat-out necessary layer of financial protection. Next, zoning and land use. You need to find the official city or county zoning maps. What is the land zoned for? R1 residential? Commercial? What can you really build there? You also need to look for overlay zones, such as historic districts or floodplains that add extra restrictions. And finally, access and easements. You need to know there's a legal right-of-way to your land. You don't want to discover that you've bought a landlocked lot that you can't even get to. And if it's on a private road, check the maintenance agreements so you'll know who fixes it. Then we have the environmental and physical inspection. This informs you of whether the land is actually able to do what you want to do with it. Number 1, a Phase 1 environmental site assessment. This is a search for historical contamination. You don't want to buy an old gas station property without knowing it. 2, wetland delineation. This is massive. A professional comes in and stakes the boundaries of the protected wetlands. Wetland development is greatly disallowed, typically illegal. If you mess this up, your land can be effectively worthless. 3, soil and species surveys. You must test the soil to see if it can support a foundation and a septic system. And you must discover if there are protected species, such as certain vegetation or wildlife, which would prevent your development. And 4, infrastructure feasibility. How close are the water, sewer, and power lines? How much will it cost to extend them? You have to walk the land, judge the topography and drainage. A heavy slope or swamp might mean huge engineering cost. Now let's talk about money. How do you finance this? Well, it's tough. Lenders see unimproved land as a high-risk item because it brings in no income. Because of this, they ask for a huge down payment, often 20% to 45%. They want to know that you've got plenty of skin in the game. Besides that, you'll also be paying a loan origination fee, usually 0.5% to 1.5% of the loan value. And then there's all the rest of the closing costs: appraisal, title search, title insurance. Land loans are just so much more restrictive and expensive than a normal residential mortgage. And don't forget, after you buy it, the costs don't stop there. You have annual holding costs. The biggest one is property taxes. That is your biggest yearly expense. The second necessity, and not surprisingly rational cost, is vacant land liability insurance. It protects you if someone, even a trespasser, is hurt on your property. It's incredibly cheap, although it starts at as low as $12 per month, or somewhere in the ballpark of $225 annually for $1 million coverage. For 100 acres, you could pay anywhere from $500 to $750 annually. Because this most dangerous risk to operate is so cheap to eliminate, your undivided best focus can stay where it needs to be, on your buy plan and expecting that appreciation to hit. Next, how do you even put a value on a piece of ground? This is tricky because there's no cash flow to analyze. Value is 100% based on potential in the future. The most common method is the comparable sales approach as with houses. But with land, it's just that much more subjective. What makes a lot similar can be hard to ascertain. There are even more advanced methods, like statistical learning models, based on data that value vacant and improved lots in an area at the same time, which can reduce human fallibility and subjectivity. Another professional method is present worth valuation, which looks at comparable lots and, most importantly, approximates the absorption rate. That's how quickly the market's actually selling and building on vacant lots in that area. If you can establish the absorption rate, you can calculate how long it might take to sell your lots down the road. I've mentioned surveys several times, so let's be completely clear. Professional surveys are necessary. Don't rely on those free web maps. You have various types for various requirements: a straightforward boundary survey, a more intricate subdivision survey, and the creme de la creme, the Alta ACSM survey. This is the most in-depth one, utilized in commercial transactions and institutional financing. It may run anywhere from $2,000 to $3,000, but it has the highest degree of certification and risk avoidance. It's money in certainty. And now, at last, for the advanced course. The one biggest way to generate money in land investing is through subdividing. This is where you hold a large raw piece of acreage, and, with a large process that is referred to as entitlement, you turn it into multiple individual buildable lots. The entitlement process is where you gain the legal right to build. You're going through the city or county to get approvals for zoning changes, utility design, road layouts, and environmental permits. It is an army: civil engineers, land use attorneys, planners. It is a headache, but your desire to get through and pay for this process is what causes the enormous appreciation. You're actually building value out of nothing by creating multiple assets out of one. You've purchased the land, you've put in the work. Now how do you cash out? Your exit strategy hinges on how you began. If you were land banking, then your way out is timing. You bide your time waiting for the market peak. You wait for indicators like all the other lots in the area being bought out, new infrastructure being built, or utilities being extended. That is when you sell. You also must choose the proper sales channel. For commercial land development, use commercial brokers and LoopNet. For recreational property, use a niche like land flip to sell it to the right buyer. And to receive top dollar, be creative. Offer seller financing to the buyer. Create a joint venture with a contractor. This flexibility can make your lot all the more desirable, especially if it still has some work to be done. So let's get to the point. What are success factors? Number 1, better sourcing. Your advantage is not buying at retail on a listing platform. It's tapping public records and GIS technology to find motivated sellers and get a discounted price. Number 2, accurate due diligence. Never, never go without it. Invest in professional surveys, environmental studies, and legal stamp of approval. That is what prevents total loss of capital. And number 3, market forecasting. You must be able to accurately forecast where a neighborhood is headed. You must understand absorption rates and development capacity in order to understand when to buy and when to sell. All right, to wrap all of this up, here are my conclusions. Investing in vacant land gives you wonderful flexibility and ease of management, but it involves significant capital expenditure and lots of patience. Prioritize acquisition sourcing first of all. Your best edge is getting off-market transactions from public records. Focus efforts here. Second, never ever bypass due diligence. Meticulous vetting on legal entry, confirmed borders, and environmental issues are mandatory upfront costs. They are non-negotiable. Third, master one niche. Avoid trying to be a resident expert in timberland, farmland, and development land at the same time. Pick one and learn everything there is to learn about it. And fourth, strategically allocate capital. Your budget isn't just for the purchase. You need to budget for all those professional certifications, the surveys, the appraisals that make the land bankable and marketable. Your profit margin is dictated directly by buying correctly and precisely knowing the market. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.